Go. We've got Andy from Finding Value Finance here. I'll be the host. We've got Scott with us, Sow and Reap Capital. Definitely go check out his channel if you guys haven't already. And if you haven't added him on Twitter, I don't know what you're waiting for, at @U_AG_. Definitely add him. We're going to talk about uranium this time. Obviously, I mean, we've got a uranium bull, and I'm obviously a uranium bull as well. We've got two uranium bulls. I guess we'll disclose up front that we are uranium bulls for multiple reasons. So we're going to go over the bull and bear cases this time, and we're going to see what's bullish, what's bearish, and I don't know. You can draw whatever conclusions you want from it, but obviously, I'm gonna start it off with Scott on the bull camp. What do you see that's bullish, Scott? Obviously, I can name a whole bunch of stuff off the top of my head, but what about you? What's bullish for you? What do you see that just makes you go?
So are we talking long term, short term?
Well, either one. Either one. It could be short, medium term. That's fine.
Okay, before we get started though, if you think we're gonna break out and go ballistic in Q4 this year, like this video. I want to see how many mega bulls there are out there. Like this video, please. I want to see. All right, so I think in the short term, there are a couple of factors. So one is really the money flow. So typically what happens with the fund managers and institutional investors is that they do tend to rebalance at the end of at the end of each quarter and rebalance their portfolio. So obviously stocks have been performing terribly, which means there's been a lot of selling. Bonds have been performing terribly, which means bondholders have been selling. So I think means the fund managers and institutional investors have a lot of money on the cash, or a lot of cash on the sidelines, which means they need to find a sector to go into. And we know that energy is probably, has the greatest momentum behind it in terms of the bull case. Energy has been going up quite a bit. I know we had a short pullback, but they will need to deploy that money, and that's fresh capital coming. One thing to note though is next week is, I think Chinese are on a holiday. So typically what happens, what I found in the past with Chinese going on holidays, it has been quite bearish for a lot of the commodities, and it's because the US banksters tend to use that opportunity to smash down prices. I don't know if it's a conspiracy theory, but that's typically the price actions that I've seen, typically in precious metals. And I don't know if it'll carry through to uranium or not, but that's just something to be aware of, like mega short term. But regardless, nothing changes what I do. My actions don't change because I'm fully positioned now in uranium. Obviously, if the prices were to fall a little bit further, or a lot further, then I will sell more PM, more precious metals to buy more. But I think short term, this is what I'm looking at. So the seasonality of the CCJ chart. And I know last year it didn't work because obviously we went on a tear a little bit earlier. I think starting from like July to September or something like that. So we did probably have the Christmas present a little bit early. But if you look at the Cameco Corp seasonality chart, you do tend to have very strong performance through to October, November, December, all the way through to potentially June. So June next year. I don't know what that's going to look like, but on chart, if I look at the CCJ chart right now, it kind of does make a lot of sense as a potential outcome. So if I just go back to the CCJ chart, I think in the short term, like the technical setup and the money flow is what matters, right? And would you agree with that more so than the fundamental developments, unless there's like a huge short squeeze of supply?
Yeah, I think the uranium fundamentals are overblown, and I think in terms of why the price moves, and I think the money flows and other sectors are underblown by most uranium investors. So I think that the majority of problems in the overall market is what makes uranium go up. It's not the uranium fundamentals. That's my take on it. So if you're studying the uranium fundamentals nonstop, I would rather look at to see what other sectors are actually doing before I'd even look at uranium. Uranium looks good from whatever measurement you want to measure it by. Now we're waiting for the money to come from all the other sectors. That's what I think.
Yes.
And it is coming.
Yeah. It is coming, I think. It is coming. So if we were to just have a run like this, so I think we're around here, and I've been talking about this for a while, but I think we're somewhere around here. We've had the first leg up, and I think we are around here, which means we could see this period here. How many months is that worth of relentless fat green candles? All right, so that was 9 bars. So if we kind of overlay this 9 bars to
That's 9
where
months.
we are right.
Yep.
Sorry, 9 bars and 9 months. So if we go from here to say 9 months, it takes us to July. And so if we go back to the seasonality chart, then it's roughly June to July that the seasonality should run for, which hopefully, fingers crossed, means we could see a pretty big run up in uranium. So that's the short-term bull case for uranium, I think. The money flow, as I said, from the institutional money, all the money sitting on the sidelines, looking for elsewhere to go. But because if you look at what's happened this week, okay, let's just recap what's happened this week, Andy. UK gilt plummeted, right? So the UK 10-year government bond absolutely plummeted, and that's what it looks like. The bonds shouldn't be this volatile, but this is what you. This doesn't look good.
That does not look good, and I probably would not go long in it just because I know how much problems they have.
Yes, look at that. I mean, it's looking horrible.
That's for bond prices.
Yes, this is bond price.
Yields are inverse of that.
Yes. So inverse of that. So I think it was like, yeah, the yields are crazy on the UK. I think I might have read an article where it said the mortgages in the UK might experience a 70% increase in mortgage repayments over the coming months or something like that. As a result of the increase in the interest rates. So it's going to be crazy. Obviously, the UK, the Bank of England is trying to step in and do some kind of QE and buy up their own bonds and try and control prices. But because they don't have the world reserve currency, I don't think it's going to work. I mean, it's not like the US where you can just print it and then you can pay back in your own currency. They actually have to pay most of their obligations in currency other than theirs, basically. So I don't know. Mostly US dollars, I think. So I think they're in big trouble. So you've got all the money flowing out of the bond markets. It's the same for TLT. So if I just look at the TLT, which is the 20 plus year treasury bond ETF, I mean, it's falling. It's falling like a stone.
It broke out of the support line too. Its bottom support line going across. It's pretty much, I mean, maybe not the long term, the shorter term from 2011 onward. But
so if we compare the relative performance CCJ to TLT, I don't know, I just thought I might do this, but yeah, I mean, TLT looks horrible, CCJ looks awesome. So I think we've got the right market conditions right now, especially now that we've officially ended Q3. And as I say, it's not to say that we're gonna go up immediately next week. If you look at this chart very, very closely, we don't need to get into this detail, but I mean, we did have a little bit of blip down at the beginning of October. So no one knows I don't know what's gonna happen next day or the next week, but all I'm saying is I think the money will flow into the energy sector. I haven't checked XOM.
What about something like SPX, the S&P 500? What about the NASDAQ? I know we've been kind of going around those two, people are saying coupling, decoupling, outperformance, underperformance, all that stuff. But the S&P 500 looks like garbage.
That looks pretty horrible like now.
Total trash.
It does look pretty bad.
Because I mean, we're starting to get a little bit of selling pressure, and it ended quite strong today. And I don't know which way it's going to go next week, but it does not look good.
Did it end strong?
Yeah, it ended. It ended pretty strong to the downside. That looks like garbage, right?
Yes. I'm starting to think that money is going to properly flow out of general equities, and obviously you don't. you can't really, because short-term movements are so much driven by psychology of human beings. It's very hard to say before it happens, but obviously now we're breaking below the 200 weekly moving average, which has been the key support here, here, and obviously that was the medical event, and then we're now breaking below it, which is probably, yeah, I mean, we've broken below it here. I mean, there wasn't a time during this run where it broke below, right? There wasn't a time during this run where it broke below, but yeah, now it's breaking below. Let's look at DJI. I think DJI is starting to break below as well. It is. So DJI is clearly breaking below the 200 weekly moving average. Once again, no time here, but all entire run here that we broke below. So it looks horrible.
Which is what we've seen in historical bull markets and commodities, though.
Yes.
That's all within the realm of what we usually see during a commodity bull market. The money is rotating just like we thought, and we've got higher yields. All this stuff is coming into play.
I think so. And typically what happens is when this is the craziest thing, right? Because typically when you have stock markets that look this bad, people tend to run into bonds, which drive up the bond prices and drive interest rates lower. But what we're seeing now is money flowing out of both bond and general equities market, which means there's more cash on the sidelines. And obviously that causes a risk. So here's the risk factor, because obviously when the money's, coming out, the market's volatile, there might be the unknown, the dark side, where we're not really aware of what's going on potentially, or because we can't know everything that's going on in the marketplace. And there might be a collapse, maybe, of an institution of some sort, like maybe a financial institution that might lead to liquidity events. Having said that, though, I think the financial system today is so different to the financial systems of the 2000s, even, in that the financial institutions are continuously talking with the Fed and the regulators on their liquidity, on their solvency. And I don't think we'll see a collapse like we saw back in the 2000s because of that. Because I think before that happens, I think central banks and the regulators step in well before. And from what I've seen in the industry as well, that's exactly what happens. You continuously engage with them when there is like a capital adequacy shortage. If there's like liquidity issues, the banks run to the regulators and the central banks. So I don't think we'll see anything. It might be wrong, but the risk that something like that will happen again this time around, when all that relationship is so well established and it's a normal practice to be doing that, is far less than back in the 2000s, for example. So that's probably something to consider.
Yeah, I saw some of these companies, they're scribing out some pretty good patterns. They're getting low on their patterns. We're getting lots of buying. Some are getting good buying pressure. Some are kind of lagging a little bit. So it's kind of a mixed bag when you look at the individual companies by themselves. Some look good. Some look like they're like, it could go lower. It all depends. In the short term is what I'm talking about, not the medium to long term. Do you think there's still the chance that we have one last spill out? And what I mean by, if you look at and maybe I'll pull this up real quick of the because I think I have it here. The stages of a bubble is what it's called. So if I were to pull this up here, I've got it pulled up. This is the stages of a bubble. I'm trying, we're trying to identify where we're at. We've got the stealth phase of the takeoff. I think we're in this phase, like kind of in here, awareness phase, takeoff phase. And have we gone through this bear trap yet? That's the question I've got. And I don't have an answer for it because, I'm staying long. If we get this bear trap, I'm remaining long and I'm going to keep going. And I think the most difficult part there is, have we gone through the bear trap or not? And I know people are trying to time this. I'm not, but time it to the degree that that they think they can time it. Because if this does take off, they're out. They're out of it.
That's right. So It's hard to say when exactly the bear trap is, but I think we're getting close, and that we're in an accumulation zone. So I think if you look at oil price, for example, this is probably a clearer chart, because if you look at this run here, I don't know, where's the if you look at this chart here, this is where the run started. You went down. This was the bear trap, right?
Yep.
This was the bear trap. This is a second leg up, and this is the blast off, right? Because I usually see 3 big runs in a commodities bull market if I look at anything. So hold on, let me just delete. So that's where I think we're around here. Like, there's no doubt I think we're around here, because if you look at, okay, let me just put, oh no, that's a bad idea, because it did go to 0. But if I look at the run here, oh, let me just overlay this, because I think I've done it last time. But if I just go bars pattern and go like this, and then overlay it to here, I think the run might look something like this, right? So we started going up, that's where we are, and we're coming down. Are we going to go down more? Because we don't have to, right? We don't have to go down more, because the fundamentals are so much greater. The energy crisis, we didn't see an energy crisis during the 2000s, and I think we might not even had the bear trap if it wasn't for the SPR release. That's what I think. Because if you look at the 1970s, for example, we didn't have a bear trap. It was just like straight rocket ship up. Yeah. Let me. So if you look at this, the 1970s, where was the bear trap? It was nothing. It was just a straight moonshot. So I think we could have seen something like this if it wasn't for the SPR release. That's what I think. SPR release has been significant, I think, a significant factor in putting a downward pressure on the prices of oil. But
in the uranium bull market in the 1970s, when did that actually start and end? Was it similar to the 2000s?
Was 73, 76. So around, so the fattest part of it came from 73, around this mark here, to 76, around here. So maybe that was the second leg up for the oil price, which means uranium should be primed. Based on this, uranium should be primed for a run right now.
Should be really close.
73,
yeah,
we should be really close. And same with the well, kind of same with the 2000 run, because uranium bull market ended in around 2007. So if I just overlay this with U.UM, for example, so it did have the final blow off top. Hold on, let me just delete this. It did have a final blow off top around here, 2007. So pretty much matching up with the second leg in the oil price, in the oil cycle. So we've got to be close, I think. If I look at CCJ here, let me go back to CCJ.
So if it matches up with the second leg, we haven't started the second leg yet in oil, but we're getting really close, I think, within months.
We are getting so close. Yes.
Yeah. So
that's a really good point, Andy. So 1970s and 2000s, I think uranium probably had the biggest run when oil was doing its second leg up. So, and imagine if you kind of sold out here and then went back into oil. Catch the third leg of oil, because that's going to be the parabolic move for oil, I think. That's going to be insane. Oh, I'm just curious now, actually. Can we do that? We could. I mean, I've always planned to do it. It's not going to be easy, as we're talking about it now, making it sound, but it's a potential. Okay, SM Energy didn't do much back then for the third leg up. So that's where it gets tricky, because typically your biggest legs come in the second legs for most of these stocks. So yeah, maybe it's not worth it. But I'm going to be spending a bit of time this weekend going through some oil charts of the 2000s to see if it's worth catching the last leg up now.
Yeah, that's good, because I was just looking at that. Now, what other bear cases are there? I mean, a lot of people say there's a recession and people getting afraid, all that stuff. And I'm not in that camp. I can't warm up to it, because that's only temporary. It's not forever. Now, a bear case could be we already went through the entire bull cycle of uranium. Could that even be a case? Could that be a case?
No, no way. No way. That's not. That is
Why are
just
we
so
laughing
laughable.
so much? Because there's people out there, they're like, the uranium bull
There
market
is
is
no
done.
way.
It
There is
peaked.
no.
It the uranium bull market peaked with the ratio of uranium in relationship to gold never really moving very much. And then that would also say that like all of the explorers never took off. You know, they took off a little bit, but not really much at all. There was no uranium bull market that looked well. Essentially, we never went through it then, right? To say that we're already done with the
We
bull
didn't.
market is saying that we basically admitted that there was no bull market that ever happened to some degree because some
Okay.
of these companies went nowhere.
Yes, that's right. Okay, so it's great that you mentioned the gold uranium to gold ratio. So this is what it looks like right now. So I see two key factors. So one is a falling wedge, which is a bullish formation, and we've broken out of it. We're consolidating above it, which is very bullish for the commodity. But if I look at this, if I draw this line here, this has been a key horizontal line going across that's been working or acting as resistance. So you can see support here, resistance here. It bumped its head twice here. And if we blast through this, that's a very, very bullish formation for setup for uranium. If I look at U.UN divided by DJ,
is that where we go GOB? Game on,
sorry,
baby.
GOB.
GOB is game on, baby. Post in the description link that we're going game on, baby.
It's gonna be game on, baby. Yes, 100%. So, uranium to Dow Jones ratio, for example. Once again, this is a horizontal. So we had this downtrend that we broke out of. So it's consolidating sideways, which is typically what you might see after a strong downtrend because it needs to work off the momentum and form a base. And then so what happened afterwards is that this level here, this horizontal line going across here, has been acting as resistance. It finally broke above, come back down, retested the breakout area, and now we're going up. So there's no way, and this is not the only thing that I refer to when I look at the bull case, because obviously you've got to look at the valuations. And my base case is that everything will do 3x the last cycle. So I know we've talked about market capitalizations and things like that. I think the best way to draw reference to previous bull markets market capital is to ×3 everything that you see. So what I mean by that is M2 money supply. If you look at the M2 money supply and the amount of money that can potentially chase the uranium stocks, back in 2007, we had, let's say here, $7 trillion of M2 money supply in the system. Now we've got 21 trillion, which is 3x, 3 times the amount of money that's available in liquid money available in the system. So my base case is if you want to measure Chemico, for example, and not even accounting for the fundamentals, obviously you will need to build the fundamentals on top of it because the fundamentals for Chemico Corporation is better than last time around because Chemico had contracted a lot of their production at a very low cost or sales price. This time, I think they'll be a lot more sensible. So ignoring all of that, I think if you want to compare Chemico's market capitalization to the previous cycle, I think you need to do 3x before you start saying Chemico is overvalued. That's one thing. Another thing is if you look at the valuations of, I've talked about this multiple times, but for example, Namibian assets, Athabasca Basin assets, they are way below what an organization, what large corporations and governments actually paid for the underground pounds. So if I take you back to the extract resources, Husab mine, for example, once again, I think they paid over $5 per pound in the ground when uranium price was at around $50 to $60 per pound. So they still paid 10% of uranium spot price during a bear market in 2011 or 12. And same in the Athabasca, Heather's Explorer, Heather's Explorer, yes. Rough Rider, I think it was Rough Rider deposit. they pay Rio Tinto. I think they had 50 million pounds in the ground. Rio Tinto paid $650 million for the Headers Rough Rider deposit, which means they paid over, I think that equates to around 20% of the spot price. And so you can see that they paid during a bear market 10 to 20% of the spot price for the pounds in the ground in a bear market. So right now, our valuations today is lower than what it would have been during a bear market, right? So has the run started? I don't think it's even started yet. So if you look at Namibian assets of today, if you look at Bannerman, for example, they're going for just over $1 per pound, which means how much is that? So that's, let's say they're going for $1.20 per pound in the ground. And the spot price is 50, let's say. They're paying 2.4% of the spot price for the pounds in the ground. That's how much they value that. If you look at other companies like Elevate Uranium, for example, obviously they've got, you know, assets in Australia and Namibia as well, with an exploration upside. They are going for just over $1 a pound as well, which means they're going for like 2% of the spot price as well. And if you look at, I mean, Athabasca Basin assets are probably valued a little bit higher than the Namibian assets, maybe rightly so. But the valuations that I've just talked about today tells us that we are like nowhere near the top, nowhere near the top.
Yeah, so I agree with you. The valuations don't make any sense for a bear case for it topping out. I can't, I'm reaching, guys. I'm reaching for the bear case. Because it's bull versus bear, and I got to get some bear stuff. Here's another bull market case. I know that you created the chart showing mini cycles and super cycles. And the chart right now is signaling a super cycle outside of the SPR release that was trying to tamper this thing down. We've got that data saying that we could be even greater than 3x, because I would say when you compared last bull market to this bull market times 3x, that was in a mini boom, but we've got a super boom, super cycle, I should say. So that's, I think, also bullish. Now, what about this? I'm going to pull up a chart here, Scott. You tell me what this says.
I think I'm used to showing you. So with this chart, this is the chart that you're talking about, right, Andy?
Yep, that one.
I think I'm used to showing you the logarithmic chart, but I mean, to understand the extent of the stone drop despite SPR release. And so this is the Dow Jones to US-all ratio, and how quickly the Dow Jones value is deteriorating against oil. Like this, we haven't seen, I mean, by nominal terms, obviously if I put it on log chart, which will probably give you this, I mean, it's a little bit different, but we've never seen this before. We haven't seen, like, where did we have this measured move down in the ratio? Never. And this tells me that we're going to come all the way down here. In my opinion, we're going to come all the way down here. We've got I mean, maybe I don't know the history well enough, but to me, it seems like with Russia, Ukraine, and Russia being one of the biggest producers of oil, and Russia also being one of the, the biggest, Russia has the biggest natural gas reserve in the world by far, right? Bar none. Like, it's like you can't even compare it. You can't even. I don't know if you've seen it, but maybe it's worthwhile me sharing it with you. So if I just go data in world, natural gas reserve, this will blow your mind if you haven't seen this before, but I'm sure you have seen it, Andy. But let me just gas reserves, our world in data. Okay, are you ready? For those that haven't seen this before, this is mind-blowing. So this is Russia, okay? So United States is there, 12.62 trillion cubic meters is their gas reserve. Are you ready for the Russian gas reserve? 37.39 trillion cubic meters. Okay, let me just show you this on a chart. This is the gas reserve. Like, they have by far the biggest natural gas reserve in the world. Let me just delete everything here. And then just put Russia and US. That's the comparison that we can draw. And let me just put the world over it as well, actually. That's the world. That's Russia. That is significant, right? So they basically produce as much oil as Saudi Arabia, which is the biggest exporter of oil in the world. They have the most amount of gas reserves in the world. We haven't seen this. We have not seen this before, where nations like this are just basically saying, no, we're not going to be sharing any of our energy with you guys, right? To the Western world, especially. And the Western economy is developed in such a way that they are very heavy consumers of electricity and energy. And that wasn't, we were consuming nowhere near the amount of energy we were consuming back in the 1970s, right? And we are so used to this lifestyle. Not only are we consuming for production, we are also consuming for just sake of consuming, right? So if you're driving around in a car, for example, well, that's oil gone forever. If you're switching your light on, for example, well, that's energy gone forever, right? So you can't really recapture that and recreate energy with it because you've already converted that stored energy into heat energy or whatever it might be. So this, I don't want to say, I don't want to sound like an alarmist, as you say, Andy, but to me, this is way different to the 1970s. And maybe, as I said, is that what you think, Andy? Because maybe I don't know the 1970s well enough. Maybe I haven't studied the history thoroughly enough to form this opinion. But what do you think?
Yeah, I think there's a lot bigger consequences this time, and I think there's a lot of perhaps bearish stuff that could happen that we're not catching. So what I mean is, like, if we get too out of balance in energy, I think economies and currencies could collapse. And that's where I have my precious metals holdings, because I'm bullish as heck on energy, but I also think a lot of this stuff could be quite volatile, where things don't work out the way that we expect it to work out in the timeframes that we want it to work out. So even though I'm ultra bullish and even though I'm long on all this stuff, I'm also long the physical metals, because it's like, man, if this sticks around, if there's a problem that sticks around, I don't know, like, how the UK and Germany are going to make it for very long. Like, I just think it's not going to work. But that's like one domino collapsing in a gigantic amount of other dominoes. So that's why I have such a large precious metals holding, because if it doesn't pan out the way that I think it's going to pan out in energy, then I go and I buy, a bunch of insurance, so to speak. But I've got charts that look like this. And this is the URNM to XLE ratio. We had this nice outperformance, coming up. We had our pullback, and now we're breaking out again, where we could potentially head higher again in a falling wedge. So, URNM in relationship to XLE, which this is the uranium ETF versus the gold and oil and gas ETF of production companies. Exploration production, and this looks good to outperform. So you're on mute, Scott.
Sorry, can you show us some URA divided by XLE just to get a longer term view?
Yeah.
Great.
So here's URA versus XLE, and you can see this large decline. And now we're starting to come on up from, like, basically nowhere. It is super cheap.
Yeah.
So that's just ridiculous how cheap some of these uranium equities are. It's also one of the reasons why I'm in it. It hopefully will offset, and diversify the portfolio with XLE. If XLE doesn't go anywhere and URA just goes skyrocketing, I've got some sort of diversification in the portfolio. But yeah, that's just kind of thinking about all this. That could be a bear case, is the energy gets so short and things get so messed up that it just crashes things.
Yeah, that is a real possibility, and we might have a bigger currency problem than an energy problem.
Yeah,
and I don't know, maybe you're right, or maybe that could play out. It could play out like that, where people just you know, like just like we got used to, you know, the lockdowns from COVID and things like that. Maybe people just become used to not having enough energy, and maybe they just like I mean, they're used to the life of just staying home, doing nothing, not really working because they can't work, because obviously without energy, a lot of the manufacturing facilities will shut down, like we're seeing in Europe, right? For example, like with the steel and aluminum smelters, and also, you know, some of the car manufacturers. So maybe that could be the case, and maybe people will just become used to the poorer quality of life, and I don't know.
But I think by not having that production, I think it will destroy the currencies because the currencies must grow.
Yeah.
So you either end in a deflationary collapse or hyperinflation. I think, and I think that's what we're seeing. So I don't know if that could be used as a bear case against the ultra short energy world. As we produce more, we go up, and then we collapse, and then we go up and we collapse, and we go up, and it cycles back and forth. But I don't know if the currencies themselves can handle it. I don't know. It's just weird because if you get too,
But I must say, we are getting pretty clear signals from the governments, though, right? Because if you look at the UK, for example, they're subsidizing electricity. Like if you look at the US right now with the Inflation Reduction Act, they are subsidizing. So we're seeing the clear trends among governments that they want to go through the inflationary route rather than the deflationary route, and they are subsidizing energy like heck, which means when they start subsidizing, you know what happens to the prices? Just like the college tuition fees, right? Skyrockets. Everything skyrockets. So I think that's what's gonna happen. I think we're in the right place. I really find it difficult to come up with a bear case for energy over the coming years. I think energy will just go ballistic, and that's my personal opinion. I might be totally wrong. It's not financial advice, but I think everything's lining up for a huge takeoff in energy over the coming years.
I agree. Do you have anything else to share, Scott? I don't know if I have anything else because we went over a lot of topics there.
No, not really. Other than be joyful always. Be joyful always.
All right. Well, that's all I've got, guys. I think that's all we've got for today. If you've made it to the end, great job. Thumbs up. I appreciate you coming on, Scott. And obviously, I think we'll maybe have you on again, obviously, as you're a frequent here. So hopefully everybody enjoyed it. Don't forget to thumb up the video. And don't forget to sign up to Scott's channel and his Twitter. All right, guys. We'll catch you later. See you, everyone.